people still have a desire to upscale, to live in a bigger or a nicer property. But the hurdles that come with that at the moment is the increased cost on stamp duty. The property market is obviously highly priced at the moment as well. Then typically when you move into a new property, it's not fresh off the shelf, ready to go. You've got to do work to it. So you need to put a new kitchen, a new bathroom, you've got new carpets, decorate. So all of these costs all of a sudden become quite unattractive.
Hello, everybody. Welcome to the Mouthy Money podcast. I am joined as ever by my good co-host, Chris Chute, who is Head of Consumer Finance at PR and Communications Agency, MRM. Chris, hello. How are you doing?
Hi, Ed. How's it going?
Yes, very good. I think we're going to talk about something which we've done a little bit more on recently and seems to be getting a lot of interest from the good readers and listeners to the show and the website.
I know I get a lot of questions on it, Ed.
Yeah,
personally.
Well, that's because it's one of those funny ones, isn't it? We're talking about property today, and the nice thing about property is lots of people tend to have one or live in one or have some sort of involvement with it at least. But what are we talking about in property today? We're talking about home improvement, and we're talking about how do you pay for home improvement. So with that, we're going to look at some of the different options, and to do that, we are joined by David Coleman, who's head of sales at master broker firm Positive Lending. David, welcome to the podcast.
Good morning. Thank you very much for having me.
Now, before we kind of dig into the topic, David, just give us a bit of background about yourself. Tell us a bit about Positive Lending as well.
Yeah, perfect. So Positive Lender and are a master broker. We are specialising in specialist lending. So we're multi-product offering across numerous factors. We look after and service the lion's share of the network and club space, directly authorised brokers, intermediaries, etc., IFAs. We've been in the market since 2008, so we've weathered a few storms and come out the other side, and we're still here flying the flag. And we are recognised as a market leader. We're a multi-award winning business. We've got a fabulous team internally. Of course, I'm going to say that, but generally they are. And, you know, one of the subjects, the subject we're talking about today is one of our busiest parts of the business. So, yeah, it's great to be in the opportunity to talk about it.
Brilliant. There's a lot going on in the property market at the moment. There's a lot of speculation about things like tax changes as well that might be coming down the pipeline. That's not for today, but it is something that we probably all got in our minds at the moment. We're all thinking about, you know, what's happening in the property market. Things don't look brilliant at the moment. Chris, you've got you've had some thoughts around this as well, haven't you, about improving and, you know,
yeah,
what to do?
Let me start where all good conversations around finance tend to start, and that's on social media. I'm often shown by Tanya, my wife, who appears on this every single week, in name, there's all these kind of accounts out there that show how people have converted a 2 up, 2 down Victorian terrace from a wreck into some kind of absolute, interior design wonder. And it's made through the magic of social media. It's made to look very easy, and the results are stunning. They're fantastic. So she's an avid follower of these accounts. There are loads of these things, which then, I believe the term is inspo, create some inspo for things that we might be able to do in our home, which then leads into a kind of different conversation about, and my first question back is, do they mention how they paid for it? And inevitably, the answer is no. So, yeah, weird, isn't it? So I think I'm really sort of fascinated into the mechanics of this, because obviously, we want to focus on helping people achieve their financial ambitions. And improving our own home has been a topic of conversation for a while. We're not looking to go anywhere anytime soon, so there's some changes we'd like to make. But then you have to weigh that up against the reality of increased building costs, weigh it up against the reality of how much value it might potentially add to the property, what kind of, if it's a loft extension, a side return, an extension into the back of the garden, or is it just a case of redecorating? What are the various options for that, and how can we go about it? And, being wanting to use this podcast for both professional and personal reasons, I thought, why don't we get an expert on to ask a load of questions of David and find out what the best potential option would be.
Good morning.
Ed, you're thinking about something similar as well, though, aren't you? Your situation where you are.
From a slightly different angle, we talked about this on the podcast fairly recently, actually, was kind of, we're looking at the idea of moving in the next probably 6 months or so. Our issue is that property prices are falling at the moment where we are. So in my mind, the first thing I think of when I walk around my house is, what can I do to this house to make this situation, improve the situation? Can I invest back into the property? in a way that would boost that price a little bit in the long run. And that's quite a difficult question to answer. I think, well, I mean, my solution at this point is to get an estate agent to come and look at it and start asking them questions about what they think would be worth the time. Because there's things we can do to it. I mean, it's silly stuff like our kitchen counter's got a big old crack in it, so we've probably got to replace that. We've got some old windows that probably need replacing. The carpets could probably be redone. But that then extends to bigger picture things like we could put our neighbours, quite a few of our neighbours have got loft extensions, so I know it can be done and that people have done it, and we could do it here. So that's rather more drastic and would be quite expensive. And that brings my question is, well, how would I pay for that? What would it cost, kind of thing? And that's where, David, that's where you come in, is talking to us about those options. So yeah, I think, I don't know, for the small stuff, should we look a little bit about the different options, Chris, and
yeah, I think so.
That?
David, what's just in terms of the demand for this though? Are you seeing an increase in people looking to do this kind of thing, or is it kind of steady, or has it tailed off a little bit? People are dissuaded by the uncertainty. What's the general feeling out there? Are many other people having these discussions over the kitchen table, like Ed and I, with our respective better halves?
A lot.
Yeah.
me being one of them, I get sent numerous reels by my wife saying, "Oh, this would be nice if we do this, wouldn't it? Let's just revamp the whole house." But yeah, the market overall in second charge is busy, and there's a reason for that. People want to do things, whatever that may be, whether it's what we're talking about here, home improvements, or another reason. They want to do things, and realistically, you and us talking here, we don't necessarily know how we're going to get that money. We just need to know we get that, right? So we're probably going to hopefully go to a mortgage professional, mortgage broker, and go, look, I want to do X to my property, whether that's an extension, whether it's a loft conversion, as you just talked about there, Ed, or whether it's just some cosmetic work and, you need to borrow a little bit less. The mortgage broker's job then is, or mortgage professional's job then is to look at how do we get that? Okay, and I suppose the first question is, why would you look at a second charge mortgage if you've got an existing mortgage? Why wouldn't you do it on your first charge mortgage? Well, we're in an environment at the moment where mortgage rates have gone up. Okay, they're lower than what they have been, but they are still a lot higher than what they were 5 years ago. So if you're lucky enough to be on a fixed rate product and still benefiting from a 1.5% rate, you're probably not going to want to disrupt that for as long as you possibly can. So if you do a remortgage on that, your rate's going to go up substantially. That's going to cost you. Plus, you're looking to borrow more money on top of that. Does it make sense? Probably not. Can you do a further advance? So the answer to that is typically yes. I mean, home improvements is a pretty vanilla reason to borrow money. But there are other factors in that. Mortgage lenders at the moment are potentially going to cap on what you can borrow. They're going to look at affordability. They're going to look at what product you've got. Are you on an interest-only product or a repayment? There's different variables about whether you can or can't borrow that money, which then drives into the market of second charge. Because the income affordability is stronger, the loan to value that you can borrow on your equity is stronger. The loan purpose can be for numerous different reasons, including home improvements. But where you're looking at doing something like an extension or loft conversion where there's structural works, some lenders may be uncomfortable with that. Second charge lenders will typically be okay with that. So again, whether you're remaining in the property and suffering the dust that comes with that renovation, or whether you're sort of exiting for the period that's done and moving back in again, a second charge lender is probably going to be more accommodating to help you where you need to.
So, David, just to take a step back, just to explain to the listeners what a second charge actually is, would you be able to just give us a sort of
absolutely
30-second overview of what the distinction between that and a first charge mortgage is?
Yeah, absolutely. So, a first charge mortgage is going to be your main product on your property, which is how you acquired your property, what you pay hopefully every month, and it's keeping the roof above your head. Additional borrowing with a first charge lender is possible, but can be quite restricted or declined altogether, depending on circumstance. Whereas a second charge mortgage will give you the ability to capital raise, effectively release equity within your property to give you funding to do whatever purpose you need it to do. And that typically could be for any legal purpose, but a second charge lender will give you more flexibility on affordability. So they'll use more of your income to get you more capital that you need. They'll typically look at a higher loan to value, which is the equity in your property. So you can release more equity from your property and effectively give you exactly what you need to do in the here and now, where potentially the existing first charge lender isn't in a position to do so.
So it's a second loan that you can
exactly.
that you have on the asset, which is the property.
You might hear them called as homeowner loans or secured loans or second charge mortgage, whichever. They all have the same outcome.
Okay.
So the essential problem here is that we've got these assets that we live in, which are our homes, and they are, in the first place a home, and they are also a form of, investment and asset that we have to put money into to maintain, to ensure that it goes for value, because you can't live somewhere and let it go to rack and ruin. You need to look after it. And we all know, I know acutely, that it's expensive to look after a home, especially, the boiler goes and that kind of thing. Chris, I remember you had a boiler go a few years back, I seem to remember, which didn't sound like a very good story, but
that was a cold
a very
week.
fun story.
Yeah.
But the point is that so many of us, we all work, and we get a monthly income, and sure, we can save, but a lot of the time it's, you need that for either a rainy day, or it's got to go into a pension or whatever for long term. So where do you find the funds to do these things that you want to do when you want to improve your home? And this is where that second charge comes in, isn't it? And it kind of provides that option.
And I think that's one of the drivers in the market. People still have a desire to upscale, to live in a bigger or a nicer property. Maybe that's through requirement because family is growing. Maybe it's just a desire to move to a bigger property or whatever else. But the hurdles that come with that at the moment is the increased cost on stamp duty. The property market is obviously highly priced at the moment as well. Then typically when you move into a new property, it's not fresh off the shelf, ready to go. You've got to do work to it. So you need to put a new kitchen in, new bathroom, you've got new carpets, decorate. So all of these costs all of a sudden become quite unattractive. And then you look at your house and you go, right, I've got a 3-bedroom house here. Could I do something with this to make it the house that I actually want? Can I improve rather than move? Do I save the stamp duty cost? Do I do that? So, and then you look at the other side of it where cost to build, cost of materials and everything like that is all more expensive. It's all very doom and gloom, isn't it? But effectively, the cost of typically of, I suppose, renovating the property at the moment over moving is probably less. And that's the driven ambition from clients at the moment, or consumers in the market looking, right, how can I do this? How can I service? How can I make it happen?
Yeah, I think that's really interesting as well. That improve, not move kind of sentiment is obviously something that you guys are seeing grow. I mean, if anything, I'd say it's probably going to become even more as if we have these potential, some of these tax changes, these slightly mad tax changes potentially come down the pipeline, make the housing market even more turgid than it already is. So people are going to have to do even more to kind of adapt where they already live to suit what they want and need. Obviously, it's not going to help people who need to move to a different location for work, but people who have a growing family, people who want more, more space, etc. This is the solution kind of thing. So let's look at the levels a little bit here in terms of cost, because at a lower level, the second charge might not be the kind of the best thing, right? And there are products that people can use instead. What is that kind of level, and what kind of point do you start lending on, shall we say?
Realistically, we could look at a second charge mortgage from £10,000 upwards. Now, we would always question when something comes into us of that level, £10,000-15,000 loan. Why are you looking at a secured loan or a second charge mortgage for this purpose? What have you explored other options such as unsecured loans, or what you're looking to do? Is it better that you do that on a credit card? Do you have the ability to pay that off within a certain period and so on like that? Now, typically, if someone's looking at a second charge mortgage for a lower loan size, there is reasoning behind it. An unsecured loan will probably be capped to maybe a 5 or 7 year term, whereas the second charge mortgage can be placed over a longer term, the term of a mortgage, for example. So the monthly contributions are more manageable. It could be that the client's got impaired credit in the background, so that prevents them from taking unsecured credit. It may be that they've already got a level of debt in the background, and actually part of the loan they're looking to do, albeit for home improvements, is maybe tidy up some of that debt as well and actually better their situation, which is a big factor in second charge borrowing as well at the moment. So once we can satisfy that actually the second charge at a lower loan size is the best route for the client, that's when we would look at it. Typically, by the time it gets to us as an inquiry, that mortgage broker, mortgage professional has already explored and had that conversation with the client. We're just sense checking it to make sure that all those bases have been covered. And then in that instance, once we've got the rationale and assuming that makes sense, then we can look at it for the client.
Yeah. As you say, at that lower level, it's kind of like, well, the options then are, if you're below if for a smaller amount, for a smaller, improvement, then a 0% purchase card, a deal on a credit card where you get kind of 0% on the interest is probably good for, anything lower than maybe £5,000 or something like that, perhaps. You still have to go through affordability checks, don't you, with that kind of thing anyway. And you have to be careful with credit cards, particularly because if you don't pay off the full amount within the interest-free period, then you'll suddenly start getting stung with high charge levels.
Absolutely.
And then, of course, you've got that unsecured loan, which is, that's pretty typical for things like people want to buy a car and stuff like that. That's often what they'll use as well, isn't it? But we really are talking about kind of at that bigger level, like, no, I want to do a big project on the house, really make some significant improvements and do it in a way that uses the asset that I already have in order to ensure that I can do this in a way that is, affordable, right? That's kind of ultimately what it comes down to as well, isn't it?
Yeah, absolutely. And I think you talking about the unsecured credit, that a credit card is perfect. Something like Chris experienced with a broken boiler. You've got an emergency, you can get a credit card fairly quickly, assuming that it's not too expensive. You can use it and you can get rid of it fairly quickly. So you tidy everything up. But what we tend to see as well, especially when someone's coming across for a second charge, they've already maybe got a level of debt. They maybe have started home improvements and they're 3/4 of the way through. And guess what? The property's half done. It's not quite there and they need to get it finished. There's usually a number of contributing factors about why they're looking at that loan. Yeah. And if you look at last year, 24, the average loan size second charge went up from around about 30,000 to 50,000 at the end of the year. Ours sits at probably around about 70, 80,000 now as an average loan size. I'd say a quarter of our pipeline is 100 grand or above. But it just shows the level of that, because what you touched on at the beginning, Ed, with home improvements, you're looking at loft conversion, it's 6 extensions. In my head, if a loft extension, which is me just being a little bit nostalgic, I think they're probably about 40, 50 grand. Probably not, probably double that. Yeah. So you want to do that. Will it add value to the property? Yeah, it probably will. You put in another bedroom and another space on your property, but it all costs money. And again, if you've got, as a mortgage owner or mortgage product owner, you've got a mortgage at 2% and you can remortgage away, but that's currently going to cost you 5%, and you want to borrow 100 grand on top of that, that's really going to hurt your monthly outgoings and what you've got left in the bank. And everything we're talking about here all comes down to cash flow effectively. You want to do what you want to do, but you still need to make that work on a financial basis. So it's about finding the best route for there.
Just on that, sorry.
Yeah, go on, Chris.
Go on, Chris. You raise a really good point there about, I also, if you ask me what a loft extension should cost, David would say something beginning with a 5, not beginning with the 100,000s and above. The cost to build is a massive variable at the moment, isn't it? That everybody needs to have, think on top before they go and approach someone for finance. And really having a handle and doing your research on that. So typically, do you find that clients before they come to you have gone and got quotes and have a very clear idea of what it would cost, or do they go and see which way round do they tend to do it? Do they see what they can get and then try and shoehorn the improvements into that, or do they come with a fully scoped out costed out plan with architect's drawings and everything else like that? You probably don't need to see those things as part of the process, but
you do to a degree. You do. So there's 2 answers to that. You get the client that started things thinking, right, I can do all this, it's absolutely fine. They've started knocking down walls, and guess what? They run out of money. Right. So they're then left with 2 options, depending on the state of play of the property and what condition it's in. You will have second charge lenders that will potentially look at it as long as they can get comfortable that the property's not going to fall over. Or if not, then effectively they would go down another product, which is a bridging loan, and they would get themselves out of trouble that way. But as I say, there are second charge lenders that will look at sort of heavy construction and renovation products there. And then the other side of it is, if a client comes and says, right, I'm looking to do an extension, it's going to cost me 200 grand. This is where I'm at the moment. This is what the end project's going to look like. The lender is going to want to know who your builder is, what your building plans are, have you got planning permission in place, what's the contingency and things like that for the loan. And that's not to trip the client up. They're going to want to understand, is the project fit for purpose, and is the client got enough money to do what they need to do? And effectively, is the property going to be remortgageable at the end of it? And inevitably, is the property going to be fit for purpose? So there's 2 sides to it. If someone's coming to and says, right, I want to borrow £30,000, I'm going to get a new kitchen and I'm going to put a lick of paint on the walls, the lender's not really going to ask, too many questions, because actually that stacks up. By the same token, if the client lives in a £4 million property and says, right, well, I need 100 grand for a kitchen, they're probably going to want some idea of quotes and terms on it, but it's all relative to the size of the property. But if they are looking to do major works on it, a loft conversion, extension, or knocking down walls and things like that, they are going to want to see a bit more detail about what's possible.
I hope you don't think this is a bit of a curveball. Was something that I was curious about, though. When somebody, so say, often when I go on a portal like Rightmove to look at houses, and I'm always, even if I'm about to move house or something like that, curious about what's happening in the market, so I have to sit and browse them. I'm sure
he's a finance geek, David. He's a finance geek.
No,
he does the same with all sorts of.
Everybody browses Rightmove and looks at their neighbours' houses and that kind of stuff. I'm sure
that is also my wife as well. Well, look at this house. That'd be nice, wouldn't it? Well, look what they're selling for.
But the thing I find interesting is often you'll see, a property will come up in my price range, right? And you'll think, oh, it's a 5-bed house. There's no 5-bed house in my property, range. And you look at it and you're like, oh, okay, that's why, because there's mold coming out of everything, and it's a disaster. But somebody moving into that kind of property and they want to renovate right from the start, do mortgage providers with the first charge, will they fund that renovation, or would somebody need to come to you for that? How does that work?
That really depends on how much the client's got to put into it. So if they were a first-time buyer, for example, and they're jumping on it, their funds are probably going to be quite restricted, unless they're fortunate enough to have had a windfall or bank of mum and dad that are really helping them out. If it's the likes, you're a current homeowner, you find an opportunity and it's an absolute doer-upper. The property I'm in right now, our family home, that was exactly the situation. We moved into it and it was all aluminium windows. There was gaps all over the place. We moved in April. It was lovely. The flowers were in the garden. It was nice and warm. We got to October and we were like, right, okay, this is what we bought. So again, there was black mold coming in. There was wind blowing in through the gaps in the windows. We didn't even notice and stuff. But we bought it as a project. So in the basis of doing that, we actually bought the property with a view. On our previous property, we'd done some remedial works and we'd uplifted the property slightly, so we'd made a little bit of profit. We then instructed a builder. We got permission from the local authority to do the works we've done. So we've done an extension out the back, single-story extension. And our goal was always really to make this a family home. We've got two young children. It wasn't about putting value on it to sell. It was about the long-term goal for it, which is good. Because as we started the renovations, the world went upside down and the cost of everything spiraled. And the profit we thought we would have put back in the bank off the back of it is now we've probably broken even. But that's the very nature of it. Typically, if someone's moving into a property, and if they're upscaling as well, even if it's within their price range, they're usually using the finance ability they have to purchase that property. They'll then need more financing. So in the second charge world, you will have some lenders that want the property to be in the mortgage name or the new mortgage name for 6 months, but you do have other lenders that will do additional borrowing on day one, depending on the client's situation and circumstance. So typically it is
possible, yeah. So that brings me up neatly to my next question, which is how you go about, as an individual in that position, finding the right product. And you have got a view on, well, some brokers don't offer it. Is that right? Or what's the situation there? And how do people find these?
Yeah, look, I think if you look at second charge mortgages as they're now, or homeowner loans, or however you want to label them, I think there's still a big stigma around them from when they were called secured loans. Back before the industry was regulated, back when they were high rate, there was probably payment protection slapped all over the top of them. There were probably big fees involved and everything else that come with it. The market has massively changed now. It's a regulated market. And actually, I believe that under best advice, every mortgage professional should be considering a second charge mortgage for their client. Whether the client opts for it or not, or whether that transacts is another story, but they should be putting it on the table. And actually, we've been seeing a lot more of that activity come through from the mortgage professionals that we work with, because actually they're looking at a further advance, which is a traditional borrowing for existing first charge mortgage borrowing. But then if that can't achieve what the client wants, it's not going to get them their desired outcome. They're also looking at a second charge mortgage simultaneously. That means they can present both options to their client, and the client can make an informed decision about which route do they want to go, which is what should really be happening.
Yeah.
And I think, you do, as consumers, individuals, we have the option where we can go directly to lenders and talk to them. A mortgage broker, what the mortgage broker and that market has done over the last how many ever years, they're worth their weight in gold. But a professional mortgage broker should be looking at a second charge mortgage where a first charge mortgage isn't possible, or it doesn't give the best outcome to the client. And that's when they should be looking at it. And if they're not, sorry to say it, but they're probably not doing what they should be doing for their client.
Yeah, I think sorry, go on, Chris.
Just going to say, David, and I appreciate there's loads of variables that go into making these decisions, and it all depends on personal circumstance. But typically, how much, first charges are what? Somewhere around about the 4%, 4%, you're getting a good deal considering where base rates at, etc. What are you looking at your typical kind of first charge? How many more? Is it 5? Is it 6? Is it 7? I know, and again, I know it depends on the individual circumstances.
Yeah.
I know it depends on but just to give the listeners an idea of what they're looking at there.
Rates actually start now under 6%, so just above 5.5% is where they're at. You can actually get lower than that with some lenders because they will score it based on individual basis, but it is a bespoke offering. But as a ballpark figure, I would say rates start at 6% upwards. It's going to be dictated, as you just highlighted there, Chris, it's going to be dictated on, how strong is the affordability, what sort of equity are you going to, what is the credit profile like, et cetera, et cetera. But, it's not unrealistic to assume that you're going to get a rate in, 6.5, 7, 7.5, that kind of area. When we look at that as a first charge borrowing, it's not too indifferent from where it is. And again, where we've seen a lot of activity in the home improvement world is the clients that want to do the major home improvements. So they are borrowing 150,000 to do that extension. Now, is that going to be at a higher rate at, let's say, 7 or 8%? Yes, it is. But it safeguards their largest debt, which is their mortgage, which currently sits at, let's say, 2.5%. So actually, overall, it makes sense. And what then the mortgage broker is doing, or speaking and working with their client, is looking, well, once you've done that extension, you've added value to your property, your product on your first charge will expire at some point, and you are going to have to remortgage. There's no way out of that. I've just had the same thing. My mortgage has gone up. It is what it is. But you've added value to property. So guess what? I've now got more equity to look at a better exit mortgage for you when that time comes about. So then we can wrap that second charge mortgage back up into a first charge and better your overall circumstance.
It's a really good point, because you need to look at this over the long term, don't you? And crunch the numbers. And that's where I think you're right in terms of the broker who can talk you through all of that good stuff, tell you where the deals are, show you where you might trip over, all that kind of thing is really, really important. And also, I mean, if I had a 7.5% on my first charge mortgage, I'd be a bit eye watering. But as you say, it's on a smaller proportion, right? So it's kind of spread over a longer period of time, which can take that pressure off and let you have that long-term view. It does require a lot of head scratching and number crunching, but I think there's a reason why you're probably seeing more people doing it and at those kind of rates, because it kind of makes sense, right?
Yeah, absolutely. Definitely.
I think this is the thing that terrifies me about the property market and the mortgage market is the rate differentials. And because I live on a row of like terrace houses that are all exactly the same. They're built at the same time to the same spec. They're all like, carbon copies of each other.
Yeah.
And having a chat with our neighbor down the road, similar age, but bought his house like 3 years before us on a 1% mortgage or something like that, something absolutely mad. And they're paying like £900 a month on it, and we're on 2.99, I think, and we're paying like 1,300 quid. And then fortunately we fixed that for 5 years, and in about 18 months time, we're going to get a massive kicking. Well, hopefully things might have got better then, but that's the thing, isn't it? It's tampering, going to a broker and then tampering with that rate that you might have and you're sitting on is a problem. So actually, is there another solution to this? And I think that's the crux of it, is saying, if you're speaking to a broker about your options in this regard, say to them, what is the full set of options here, and can I use a second charge as a way to not affect what my basic product is here now that I'm happy with, and create that kind of extra additional uncertainty and frankly cost.
And absolutely. And if you look at a first charge, if you're in a fixed rate product, regardless if you've got an attractive rate, which is probably no longer available in the market, redeeming it with it whilst you're tied in comes with an early repayment charge, which could look at 3% of your balance of your loan. So actually, do you want that additional cost of refinancing at the moment, or do you want to avoid that? But you still want the money right now, right? So you need to get your money to do what you want to do. So what's the best financial route forward for that? Is it a remortgage, or is it a second charge, or whatever it is? And that's where the mortgage broker comes in, because they go, well, actually, we can look at all these options. This is what it looks like this way. This is what it looks like this way, and so on. And it's one of the drivers why the second charge mortgage market is so busy at the moment, because actually it's a cost-effective way for the client to do what they want in the here and now until the time is right for them to do something again with their first charge mortgage.
Yeah, really interesting. I think that it's something that I agree that kind of the old fashioned way of calling it, like, secure loans and that kind of thing, it does make you kind of like, oh, they're going to come take my house if I don't pay it back, sort of stuff. It gives, but I think that there's obviously a lot more nuance and accessibility here, and it is a genuine option. And it's because this is the other thing, right? Is so much of our wealth now gets poured into our property, because that's one of the easiest way in order for us to build wealth in the long term. But how do you tap into that? It's such a big question for so many people. How can you use that to your advantage to improve your circumstances, now, today, kind of thing. So yeah, really, really interesting. David, if people want to learn a bit more about your business, about positive lending, where can they go?
Yeah, so our website is www.positivelending.co.uk. You can find me on LinkedIn. I'm not too hard to find. I'm usually on there. You can also drop me an email as well, which is david.coleman@positivelending.co.uk.
Brilliant.
Yeah, just for the listeners' perspective, we don't, when we're talking about any product ranges that we offer, there is no cost for that. There is no payment to the client until a deal goes to application. So yeah, a lot of the stuff, as you can well imagine, when you put the title specialist in front of it, there's a lot more to digest and get your head around. And there's a number of that business that doesn't transact because it's not right for the client, or it's not the right time for them, etc. So conversations and looking at what can be done or not, obviously that's all free, and we're happy to talk to brokers, consumers, etc. about that and see how we can help them.
So if you've got any questions, listeners, get them in the comments, or drop David a line or us a line, and we'll see what we can do. Want to hear about all your renovation projects?
See them on Instagram.
We can talk about, in a year's time, we can come back and talk about the loft conversion disaster that I had in my house. Brilliant.
Ed in a hard hat, live from the leaky roof.
That would be a good episode.
Exactly, yeah. In our nice dry houses. There we go. All
right. Well, I think we've got a really nice, little understanding there of how this works. So, David, thank you so much for joining us.
Thank you. It's been great.
And Chris, thank you as ever.
My pleasure.
Thank you to all the listeners and the viewers on YouTube, obviously. With that, I should say goodbye. Thank you and goodbye.
Have a good day, guys. Thank you.
Thank you for tuning into the Mouthy Money podcast. Don't forget to hit like and subscribe on all our content. Follow us for more on your preferred podcasting channel, including Spotify, YouTube, or Apple Podcasts. Stay in touch by following our social channels on Instagram, TikTok, and LinkedIn. And don't forget to subscribe to the Mouthy Money newsletter on mouthymoney.co.uk. The Mouthy Money podcast is produced for general informational purposes only. It should not be construed as investment, legal, tax, or other forms of financial advice. If in any doubt about the themes expressed, consider consulting with a regulated financial professional for your own personal situation. Past performance is no guarantee of future results. Investments can go down as well as up, and you may get back less than you started with. Never invest more than you can afford to lose. For more information, visit fca.org.uk/investsmart for more. Thank you.